this session specifically for the workshop taken by our esteemed guest, Mr. Rahul. Now I request Dr. Rupali, kindly welcome guest.
Thank you, ma'am. A very warm welcome to C. Rahul Khurana ji. It's a privilege to have you here with us at the Amity University, Amity College of Commerce and Finance. To inform our participants, they were actually in a class right now, so the class has just ended and they're in the process of joining. So, Professor Mr. Khurana is an experienced financial professional with experiences in managing cost, budgeting, accounting, finance, capital budgeting, decision, taxation, and audits. He's a chartered accountant with specialities in accounting, budget preparation, computer skills, inventory management, telecommunication industries, cost records maintenance. It's a privilege to have you here, and I'm sure the students would benefit from your experience, expertise, and many of them are also pursuing chartered accountancy. I'm sure your interaction with them would definitely benefit. Over to you, sir. I think
I'm audible? Is I'm audible? Yeah, thank you so much for such a warm welcome. And I would really like to first appreciate the team as well for taking up such an initiative, so that the student can also get to learn a lot from the practical experience. So as far as today's session is concerned, so we will be talking much about the cash flows and all those things. And about once I talk about the cash flows, so I would start with very first basic things. So just wanted to know, I hope everybody is from the financial background or a finance and accounting background only. So just to recap, just to understand that what is accounting and finance. So it is a very plain definition kind of thing, wherein I have given the basic definition for an accounting and financial management. Generally, people do confuse between the accounting and finance in the industry overall as per se, but there need to be very set guidelines. There need to be very clear understanding about what is an accounting and finance is all about. So I'll just start with the accounting bit. As far as accounting goes, it is more with the recording of the financial transaction. So it is just an act of collecting, recording, and presenting all the financial transaction of the organization. However, if I go for the finance meaning or financial management kind of thing, so every person in an organization may or may not be an accountant, but in any of the business organization, every person is a finance person, in a sense that its action or not to take an action generally impacts the profitability or the finances of the firm. So if I go by the definition, the ability to understand the impact of every decision you make on the organization profitability, and then to ensure that you take all those decisions that will strengthen the bottom line, wherein bottom line is meant by something like a profit from the operations and do not weaken sales. So if I go with the very simple part, so something like, let's say a person leaving an office or a room, if he puts do not close the light switch buttons, so that is also action also have a financial implication on the profit. So in any case, if the light wastage is there, the profit of the firm is going to go down. It may be very high amount of impact, or it may be very low amount of impact. So I hope I have made it very clearly distinguishment between an accounting and the finance or a financial management. So this difference has to be kept in mind whenever we are going to get into further into our jobs or maybe into our professions, something like this. So this is a very basic difference. We have already studied in during our early days of education. But yes, what happens is gradually once we increase to the different levels, we tend to forget these differences. With that, I'll move to the next part. So why an accounting and finance are important for the business? If anybody would like to share his thought on this. he can unmute himself, or do I have to, or he can raise the hand if anybody would like to participate on this part. Is the moderator is there?
Yes, sir. I'm here. Uh,
Okay,
but the
ma'am.
students, yeah.
Okay, so can we make it a little bit interactive session so that student can also participate on this?
Okay, let
Is
me
it
just check
possible?
with the
Yeah, is
settings.
it possible?
Yeah, I'll check with the settings and I'll get back to you on this. Yeah.
Right, right.
Actually, sir, students are unable to specifically unmute themselves. They may
Okay.
write down in the chat box or they may raise their hand. Students,
All
please
right.
raise your hand so that
So
our
anybody who
IT
would like to
person
contribute
will
can raise their
unmute.
hand. That will be, yeah. Yes, yes, that's fine. So I'll just proceed further on this then. So why an accounting and or finance are important for the business? It is more like if we are not doing the accounting properly or not keeping an eye on accounting properly, just imagine a cricket match without a score. It is something like that only. Just imagine you are watching a cricket match and the scoreboard is not available in that. Would you be able to make out how the one team is doing or maybe the another team is doing? So it is something to like the same situation is there. If we do not have the proper control over the accounting or finance, or the we do not have properly accounted books, so it is something like we are playing without the scoreboard. Since we do not know whether we are going into the right direction or not, whether we are going with the right rate, run rate or not. So it is something of that importance. As much the scoreboard is important for a cricketing team to play in a match just to ensure that he's in line with winning the match. Similarly, accounting and finance functions are also critical to the organization just to understand whether they are going into the right direction or not. So generally, there are three kind of financial statements that every organization should prepare or generally they prepare. So it's one is the balance sheet, profit and loss account, and we have the cash flow statements. I think most of you must have already heard about these statements. So I'll just take you forward just to brief introduction about these statements. If I talk about the profit and loss account, the basic purpose of making up the profit and loss account is just to know whether you are making out the profit or losses during a particular period of time. Just to make you recall once again, it is a period statement. When once I talk about the period statements, that means it shows the profitability or the whatever losses you have incurred during a period. So it is a flow concept, which is basically deposit you what you have done with your during that particular period. Another concept I would like to mention over here is in any of the organizations, generally sales is termed as in top line of the organization or generally termed as in top line of the organization, and the profits or losses, whatever the case it may be, it is generally termed as an bottom line of the organization. So always remember one thing, top line is merely a mean towards achieving an end, and the end is to have the healthy bottom. So I'll just make you recall this statement or make you understand this statement once again. Is basically this, that if I talk about over here, the sales, which is the top line of the organization, it is just a mean to reach because the ultimate aim of any business is to get profitable and give the right amount of return back to their owners or their stakeholders. So once again, I'll just made you read this quotation again, that the top line is merely a mean towards achieving the healthy bottom line, which is nothing but the profitability. So in that sense, so generally what happens in many of the instances, practically we see that businessmen keep on running behind the top line without bothering about the bottom lines, which in my opinion is not a very good approach to follow. They generally keep on watching on this participant, or they keep on comparing. Last year they did a turnover of let's say 15 crore, and this year they are ending up the turnover with the turnover of 30 crore rupees. So ideally they have doubled their top line, but have they actually doubled their bottom line as well or more than that? Because ultimately whatever you're going to take home is the bottom line. So your profitability, your survival, your success is dependent upon your bottom line. So once you talk about the top line, you also have to keep a watch on your bottom line as well. Do we have any questions, any concerns up to here? If anybody has any concern, any questions regarding up to this level, he can raise his hand, or we can then proceed further on this.
Any student with a query, please can tell us now. I think so you can proceed now.
Right. So as we talked about the profit and loss account, now let's understand the balance sheet. The basic purpose of preparation of balance sheet is to get to know the position as on date. Once we talked about earlier, when we talked about the profit and loss account, we talked about something like it is a flow statement. However, the balance sheet is a stock statement. That means it is presented as on particular date. So these basics have to be kept in mind, that whenever we talk about the balance sheet, it has to be as on particular date. That is why whenever you prepare a balance sheet, you keep on putting up this thing on the mind, that is as on particular date, maybe as on 31st of March 2022, something like this. So since you are already from the finance background or accounting background, I'll just give you a brief of balance sheet. So these are the brief headings, broad headings in any of the balance sheet. Like on the asset side, we have a fixed asset, which is not majorly known as an your non-current assets. Then you have the current assets which are realizable or expected to be realized or converted into the cash and cash equivalent within a period of 1 year. Then on the liability side, you have current liabilities which are required to be paid off within a further period of 1 year or so. You have loans and advances from the outside, and then you have the owner's equity or the capital contribution done by the promoters or the owner. I'm sorry. So what are the most common problems of all the business owners? Let me tell you a very brief thing, that in any case, most of the business owners come into the business, leaving their jobs or maybe not opting to go for any other thing, just to considering one fact that they will be earning the profit. So that is the general conception, that you come to the business for your profits, for earning the profit, which is the right as well in the sense. But in the longer run, what happens, businesses do fail even though they have the profit due to one reason or another, which we will be discussing more into the once we go more into the detail of this presentation. So what are the most common problems of all the business owners? So this is very simple, that is show me the money. So what generally happens, if practically most of the business owners, however, although they have been showing a very good profits, but in actual, the cash profits are generally not there. So that is one of the basic problems, which is an agenda for today's session as well, about the cash profits or about the cash flow management. So I move further with this. So generally, what kind of circumstances do a business owner faces? Like generally at the end of the period or maybe end of the month, we took a loan and still we are struggling with funds. So these are the common statements faced by the business owners. Something like, I have pumped in so much money. गया कहाँ पैसा? सर मंथ एंड आ रहा है, सैलरीज और बाकी खर्चे के लिए पैसे चाहिए होंगे, सप्लायर्स भी रो रहे हैं, बैंक ओडी और ओवरड्राफ्ट फैसिलिटी पूरी यूटिलाइज है, बैंक से बात करके टेम्परेरी ओवरड्राफ्ट फैसिलिटी और कहीं से लोन मिल सकता है क्या? तो look, in any case, a business owner might be earning on the unit economic basis. Once I talk about the unit economics basis, it is as simple as that. He might be purchasing a particular thing at 5 rupee and selling it at 10 rupee. So he is making the profit by selling every unit. But on the consolidation level, he's not may or may not be making profit. But another aspect is whether those profit are converted into cash or money. Because even though at the end of the year, if they have money or if they have profits shown over there, but are those profits are realized in cash or can the business owner take that money, that can the businessman can take that profit to his home so that he can achieve his ultimate aim of getting into the business. So this is very much important thing, that the aim should not only and only to be the earn profits as well, but to get or to demonetize those profit as well, to get those profit in terms of monetization as well, to get those profit in terms of cash as well. So with that, we will move to the one of the very interesting topic, which is profit versus cash profit. As a student of finance, as a student of accounting, I would love to say this thing, that you should have this basic understanding that what is the difference between the profits and the cash profits. So what is a profit? In general terms, it is a sales minus the expenses. So whatever you have sold during the period, less the expenses, is generally termed as a profit for the year or profit for the period. However, what is a cash profit? So cash profit is nothing but your money collected from the customer less the payment made for purchases, expenses or taxes. If we are earning, let's say, huge amount of profit, there can be cases where we might not be earning a good reasonable cash profit. So that, for example, let's say in my organization, my sales team is doing such a thing that they are focused totally on the sale of product, and they are focusing absolutely on the sale of product. By just because of their focusing on the sales of product, the sales has doubled. But what actually has happened, that sales which was doubled, they could not be able to collect that into the cash. So as of now, those are appearing as in debtors in my balance sheet. For example, let's say earlier I used to give 3 months credit to my customers. I used to say that you can take the product today and give me back the money for these product maybe 90 days. Just to increase the sales, my sales teams do one thing. They increase the period to 6 months. Automatically the customer will be very happy that he can get an extra credit for 3 months and he will be ready to purchase more out of my rent. So my sales in any case will go up, but my cash profit may or may not go up. On the other side, on the expenses side, I might be incurring a lot of expenses, but those expenses are generally can be bifurcated into two parts. One is a cash expenses, another version is a non-cash expenses, something like a depreciation, amortization, and all those things. So these things, although which are very important for the profitability perspective, but may and may not be very much important from my cash flow perspective, because those will not impact my cash flows of the business. I hope I'm making sense and things are clear up to now. And if any question is there up to now, we can attain up to now. Any question by any of the student, he can raise his hand, or any of the concepts. So what we have done up to now, we can just have a recap of that thing. So very quickly, I'll just run you through. We understood what are the statements, we prepared profit and loss account. We also concentrated on the fact that the top line is merely a means to achieve the end, and actual aim is to earn the healthy bottom line. We understood about some basic concept about the balance sheet and what are the common problem which is faced by most of the businessmen, that even though they have a reasonable amount of profit, they do not end up with the having the equal amount of cash amount available with them. So that is where we started up the discussion on the profit versus the cash profit. I'll move further, that always there is one important point that we always have to keep remembering ourselves, this thing, that the profit and the money are two entirely different things. A business might have made the huge profit but still have no money. It is equally possible that it's flush with the funds, but it is suffering losses. For example, I can give you the examples for both the situation. As I told you earlier in an earlier example, wherein I mentioned this thing, that a business owner who has doubled his sales, But actually the basic reason behind why he has doubled his sale was that they have increased, their sale team has increased the credit period. So automatically what will happen? Their profit and loss account for the statement, which is made on the accrual basis, will show huge amount of profits. However, since the collection of that profit or collection of those sales is still pending to be received, they might not have that much amount of cash available with them, and they might pinch with the cash shortages. On the other side, it is very much possible that, let's say, if today in this particular year I have taken up the loan from a bank for, let's say, 50 lakh rupees in a business. However, my business is going into losses. However, I'm incurring a losses, and the amount of a lot of money is pending to be paid for by creditors. But still, those 50 lakh rupees which I have taken up the loan from the bank is lying up with my bank account. So in a sense, I will have huge amount of cash available with me. But on the other side, I might be end up being a negative, having the negative figures in my profit and loss account, or having the losses in my profit and loss account. So I hope this statement is clear to everybody that the profit and money are two entirely different things. And a business might have made huge profit but still have no money. So this pertains to the first situation, wherein we have doubled the sales, and those collection for those sales has not been made. On the other side, it is equally possible that it flushes with the funds but is suffering losses. This is the second case wherein we can assume this thing, that a business has incurred the huge losses. They have made up, they have incurred huge expenses, but payments for those expenses is pending to be done. So as of now, those are appearing in my balance sheet as my liability. So although I have a surplus cash available with me, but in actual I have incurred losses. I move further with this. So why should we should always compare? So we have understood this thing, that there can be cases where there can be profits and there can be cash profit which are totally indifferent from one another. So we should always compare those two things just to have a better control over our business. We should always have a control over this, and we should always keep on comparing these two things. What are my profit and what are my actual cash profit? This is very much necessary. In a sense, I'll just give you a very small example. Let's say at the end of the year, my accountant comes to me and he says, "Sir, we have made up a profit of, let's say, 5 CR in 5 crore rupees in last financial." So I'll say, "Wow, that's a great news. We have made 5 crore rupees. That's wonderful. So let's do this thing. Let's go ahead and buy a new car for 2 crore rupees. Since we have already made up the profit of 5 crore rupees, I have not withdrawn the money during the last year. Why don't we celebrate this in a sense that we can buy a new car of 2 crore rupees?" However, once I go to my accountant and say, "So just give me a check for 2 crore rupees so that I can buy an out of those 5 crore rupees so that I can buy the new car," he says, "Sir, the cash is not available." I ask, "How is it possible? You were saying we have made the profit of 5 crore rupees. And once I ask you for 2 crore rupees, you're saying the cash is not available." So he said, "Sir, we also have to collect money from the markets in the form of debtors and all. And we have also invested in our stock in the form, and actually the total collection pending from the market is around 10 crore rupees. So whatever profit which I have earned is right now lying it with my debtors." So just to ensure these kind of situation, we have to first compare our cash profits to the normal profit. So the first part is just to find the difference between the cash profit and normal profit, and then to analyze those differences. So let us understood by the way of an example. So if this, in this particular example, we can see this thing, that the profit and loss account, we had a profit of around 8,70,000 rupees. So there were non-cash expenses. Since these are non-cash expenses, my cash profit was going to get increased further. So I just added back to this normal profit. So I add back 4,500 rupees to this. So there is an increase in payables. Increase in payables in the sense that last year, let's say my payable was 40 lakh rupees. This year it has gone up to 62 lakh rupees. So obviously if I assume this thing, I have also taken up in another sense, I can say you very simply this thing that I have taken up a loan of another 22 lakh rupees from my creditors in the form of purchases, in the form of expenses. So that is also not a non-cash expense kind of thing for me. So I'm again adding it back. My debtors has gone up by 20, has gone down by 24 lakh rupees. So it's a reverse case scenario wherein at the start of the period, my debtors was, let's say, 40 lakh rupees. At the end of the period, it reduced to the 16 lakh rupees. So I have realized something like 24 lakh rupees out of my opening debtors. Although since the profit and loss only shows up the period statement or only concentrate on the profit and loss for the period, I again have to adjust these kind of things just to reach to my cash profit. So I am decreasing this amount from the profit and loss. Further, I have increased my inventory levels by 9,20,000. It is something like my inventory at the start of the period maybe was of 10 lakh rupees. Now it stood at 19.2 lakh rupees, 20 lakh, 19 lakhs 20,000 rupees. So it is something like I have further invested 9,20,000 rupees. The profit and loss account, since it is being made on the accrual basis, will not account for this increase in inventory as well. But my cash profit will get impacted because of that. Since I have further invested into my inventory, my cash profit will further go down. So if you see this particular example, we can see this saying that although the business, the profit and loss account was showing a profit of 8,70,000 rupees, but in actual, my cash profit was only 2.45 lakh rupees, which is a negative. So actually, I was having a cash loss in this particular year or in this particular period. Is I'm making sense with this example? Student, can we have a raise of hand if I'm or if we have any question? Can we have a chat? We have a chat box available, because otherwise I will keep on running to the next topics and I will not be able to understand whether you have understood the concept or not. These are very important concepts to go further. So if anybody wants to repeat this thing, or maybe anyone have any question on this, any confusion on this, can raise his hand or maybe write it down to the chat box. I'll proceed further in that case.
Sir, you can proceed, sir. Students are clear
Right.
with these concepts.
All right. So why to compare? So the next question is, why should we compare these things with the cash profits and the profit? What is the need of that? The very first reason why we should compare is liquidity or availability of the fund is crucial. It's critical to the existence of any business. So as we understood in the last example, wherein we started up with the profit and ended up with the cash loss. If that kind of liquidity, if the funds are not available with the business, we might be doing a very good business, we might be earning a profit on each and every sale, but there can be, since those profits are not realized, we might have a shortage of cash. And to be in the business, to keep on rotating the money, to keep on rotating for the working capital purposes, I need those liquidity. So it is very much important that whatever profit I am earning, that should also get converted into the cash profit as well, so that liquidity is all time available with my business. Then we have consistent low profits can lead to the lower net profit in the future. We have to understand one factor, that my business is nothing but since I earn on each and every transaction. So whatever number of turnover or whatever the number of rotations I can do with my working capital will definitely going to increase my profit as well. In case we have a low cash profit today, so then automatically the rotations will go down since I am short of working capital. And accordingly, in the same way, my profits for the net profits for the future will also go down. Further, there can be cases since we have a low cash profit, most of my money is stuck with either with inventory or with the debtors. So automatically, a higher number of debtor, a higher amount of debtor can also lead to the bad debts. Remember one thing, if the money is collected within well in time, so there is a high possibility of having a very low amount of debt. But if we go to a customer and ask him for the something a payment which is almost 2 years old, there will be very high percentage of chances that it will have a huge amount of bad debts, because at that time we we in ourselves will also have a mindset where whatever we can recover out of this will be good. So let's say if I have an old debtors of 1 lakh rupees, even if today he comes to me and says I can pay only 50,000-60,000 rupees, I will be good to accept that. I would say it's good. Rather than nothing come to my way, I can accept at least 50,000 rupees. In the same way, if I have a long compiled up inventory or stock available with me, so what happens generally in any business, the stock gets obsolete after a time. So once the stock gets obsolete, it can be only be sold as in scrap or something like this, or maybe at a lower rate. So automatically, since today I do not have a very good cash profits, since most of my money was invested in the stock, but in the future, once I am going to sell these things as a scrap, my profit for that period is going to get down. So point number 2, consistent low cash profit can lead to the lower net profit in the future as well. Then the third one is the healthy bottom line. So what happens generally is, once we show up the healthy bottom line or a very good profit, the expectation of all the stakeholders gets increased. For example, if a business is making a lot of profit, automatically their employees will also be standing over there asking for their share. They might ask you, since you are earning a lot of profit, give us an hike. Their supplier will also come to you and say that please give us a reasonable rate. Their service provider will also ask for a fee hike. So whenever there is a good profitability shown in the balance sheet, automatically it increases the expectation of all the stakeholders. If the company do not have the comparative cash profits available with them, they, in that case, it can become a very big problem for the company, because their profit and loss might be showing up a lot of profit, the expectation might have already gone up, and since they are short of cash profits, they might not be able to meet those expectations, and automatically the morale of the stakeholders will go down, and that is going to impact my future profits as well. So it is very much necessary to compare the profit, once to maintain the liquidity, two, to understand that the consistent low cash profit can lead to the lower net profit in the futures, and third is to maintain the expectation of the stakeholders. So if I have the cash profits matching up with my actual profits, so automatically I will be reasonably happy to maintain to meet the expectation of my stakeholders. How to control? So we have understood the things that I can say something like this. Let's say if I talk about the cash and the profits, if profit is a blood, then cash is something like an oxygen for the business. So both are necessary. The profits as well as the cash profits or the cash, both are necessary, because if one is available and another is not available, automatically what will happen? It is going to hamper our business in the future. So how to control that thing? How to control your cash profits? We can simply control our cash profit or a business by just controlling three things. If we control these three factors, we can actually control our business very well, and we can have both healthy bottom line as well as we can have the healthy cash profits. So first, the very first factor is the stock. Stock is a very important aspect, very important factor in having a financial control. In a sense, let's say I have two businesses. One business is of milk products, in which the stock is of perishable nature. So generally, whatever stock I buy, so what happens is because of its perishable nature, it has to be sold within a 2 days or 3 days time. If it is not sold, it is a waste and loss for me. Automatically, what will happen? I will be more conscious about my stock, because any stock which is old, which is obsolete, or which get due to its perishable nature, which gets bad, it's going to impact my bottom line. So there is a very much necessity to have a good control over the stock in that kind of business. So if I see in this particular example, the business owner will be very much concentrated on the stock. He will order the stock very cautiously, and he will also manage the stock very cautiously. Similarly, let's say we taken another example of a gold seller. So he will also have a very, because the value of the stock is very high, he will also have a very limited stock and we will kept very cautious. So generally what happens in these kind of business where the goods are perishable or where the goods are of high value, we have a very good stock controls or very good. But on the other side, if I have a very low amount of stock, low value of stock available with me, for example, in the case of, maybe we can take an example of a light manufacturing company which manufactures the LED lights. So generally what happens, since the cost of those LED lights are very low and the sale price is very high because they had a very good high margins available with there, so they do not bother much about stock. Generally they keep on buying these stocks, but in the same sense what happens is over the period of time they have compiled up a lot of stock which is actually of no use. So we have seen this practically happening with many of the organizations where they have compiled up stocks, and where it has actually happened that after a time, once their stock gets obsolete, they had no option but to book a loss of that. Because at the end of the time, end of the day, end of the period, once they go for the further investigation on those stocks, they found out that these kind of things are already obsolete in the market. They are no longer, since the new technology might have come in, since the new styles might have come in, since the new taste might have came in. So because of those, these things are obsolete now, and we have no actually realizable value out of this. So there can be two kind of things which we can do, kind of controls which we can do just to keep the stock into our control. One is an aging analysis. So what do I mean by the aging analysis? It is generally represented that how old the stock is available. So let's say we journal in this kind of thing, we have a 2 to 3 buckets available with us in which we categorize all the stock. So what we generally do is, one is we categorize, we pick up each and every stock and see how old is it. So whether it is between the category, let's say you can say 0 to 30 days old, maybe 60 to 30 to 90 days old, or maybe 90 days or above old. So for me, the most important stock which has to be concentrated upon or which has to be taken into consideration will be the old one, because there will be a higher chances, one, as in whether that stock is whether that technology is available right now in the market or not, whether those colors are, so whether the stock is obsolete or not. Two, as in whether that is correctly available with me or not. Is it something like that stock has already been broken down, something like this kind of condition, it is only appearing in my books of account, however the physical stock is not there to be seen. Why? What is the reason? What is the bottleneck? Why this stock is lying up for such a long period? So these kind of analysis can come out of the aging analysis. Another thing which can be done, or which is generally being done by the organization, is they can have a periodical physical accounts, and wherein an external party came in, they do the physical count of their stock and then they do the matching up with their books of accounts. Because it is not very much necessary that whatever amount of stock which is available in the books, that is available actual as well. There can be cases of pilferages as well. There can be cases of broken down pieces as well. So all these kind of problems are available. If I move to the next part, so after the stock, the next very much important aspect will be debtor. So again, as we discussed earlier, as I told you earlier, that an old debtor can have a very high chances of having a bad debt. Again, the similar kind of thing is there, that we need to do a aging analysis for debtors as well, wherein we sit for each and every debtor and see how old that debtor is, from how much time he has not paid us. Just because of this thing itself, we can actually get a list of debtors which are actually are in problem. So I take up an example. Let's say today in my books of account, the amount of debtors appearing is something like 1 lakh rupees. However, out of this, 20,000 rupees of debtors is such that it has not been paid since last 2 years. And I know this thing, once I go for asking for this 20,000 rupees, the customer may and may not pay for this amount. So I have to offer him certain amount of discount just to get whatever best I can get out of it. So maybe I can say this thing that 20,000 rupees has a realizable value of only 10,000 rupees. I'm assuming that the customer will be asking for 50% discount while paying up for this. So these kinds of problems, these kinds of debtors do not pile up over the period of time. This problem again can be solved with the help of an aging analysis. Another factor is a good paid master. So in any business, as we discussed earlier, the profits are very much important. But the another important aspect is the cash profit. And my cash profit depends upon somebody who actually pays me in time. So in any case, I have to concentrate on a good pay master. Just to get a good pay master out of my account, a good pay master is a customer who generally pays within timelines. So if I have a good pay master, a kind of thing, a kind of concepts available in my organization, so what I will do is I basically sit down, try to catch up the aging analysis of each and every debtor, and then try to figure it out that who all are the good pay master, in a sense that who are all who pays within time. Let's say if we have a credit period of 60 days or a 90 days, who are all persons who pay before those 60 days, or maybe within those 60 days or are dot 60 days. So those are more predictable and I should do more business with them. I should do more concentrated business with them and concentrate more on them so that accordingly I can get most out of my business. The last one is the expenses. So what we generally do is the CRA analysis for the example expenses. So what do we mean by CRA analysis? I'll just give you a brief about it. So we sit with the profit and loss account, all the heads of the expenses in the profit and loss account. We categorize all the expenses into 3 categories, where C stands for continue, R stands for reduction, and E stands for elimination. So what happens is, let's say in an organization, let's say I have 100 telephone lines. I mean, my total bill for those telephone lines in a month is 1 lakh rupees. Now I have to see this thing, whether should I have to continue with this expense, whether it is benefiting my business or not. If let's say it is benefiting, but the benefits are not up to that amount, it's not commensurating with that 1 lakh rupees a month expense. So in that case, I have to take a decision and reduce the line. Maybe if I can see this thing that out of 100 lines, I can reduce 40 lines and I can only work with the 60 lines. So in that case, I will reduce those expenses. I will keep that to the reduction category. Or the third one is, let's say if today no one uses those landlines anymore and all of the employees are using their mobile phone only, for which I'm giving them the facility for recharge and all. In that case, I have to eliminate this expense. So for each and every expense, similar is with the electricity part, similar is with the purchase part, similar is with something like marketing expense. Let's say we are doing an online marketing, we are running up an online marketing campaign on Facebook. Benefit I am getting out of that expense. So while if I am incurring, let's say 1 lakh rupees a month for my online marketing, which is a budget for the month, whether I am getting right amount of sales to generate at least minimum of that lakh rupees of profit so that those expenses can be catered, or whether there is a requirement to reduce that kind of, so that kind of business analysis need to be done. If we control, so let's go back to that balance sheet level. I'll just show you one thing. So we are on the balance sheet level. Now, if you see, debtors will take over, debtors and inventory will take over most of my situation over here in the current assets. So I'll just highlight this thing. So with the help of a debtor and inventory, current assets will be taken care of. On the other side, if I see capital, capital is being taken care with the help of an expense, let's say. Because capital is nothing but the summation of whatever money you have infused as well as whatever profit you are earning. So if I have control over my expenses, automatically my liabilities, that is payment to creditors, will get controlled. Lower the expenses will lead to the lower of the payables amount. On the other side, lower the expenses. Lower expenses will always have. So we can see this thing that with the help of these analysis, we can actually control our balance sheet and we can actually help the business in getting over it with the good profitability as well as with the good cash management. Up to here, one part of our topic is over. Like we have already done with the cash flow management and we have already understood the concept of profitability. Anybody having any doubt? Can we move to the next part? Is the screen visible to everybody?
No, sir. No, sir. Please share
Is it-
your screen.
Okay. Is it visible now?
No, sir.
My rights has been changed somehow. The screen sharing is stopped.
Sir, please try now, sir.
Just now this. We are good up to this level.
Yeah, sir, it is visible.
Yeah, okay. And we are good up to this level. I hope things are clear up to now. Anybody having any doubt? Because we have covered most of the part. We are only left with one small thing. So as far as the cash flow management is concerned, as far as the profitability is concerned, we have gone through the majority of the topics. Since we do not have any questions, so we have ample time available with us. Anybody having any questions, any points to be shared, or maybe any clarifications required, we can have that. Otherwise, we will leave for move to the last topic of the day.
Yes, students, if you are getting any doubt, please ask or write down in a chat box. So you may continue till then we may get few queries.
All right. So I'll move to the next part, which is an asset liability management thing. So asset liability management is nothing but it is a concept which is generally being used by the banks. However, this is a very much important concept, which is actually practically being used by each and every organization. In the traditional businesses, generally asset liability management kind of thing was not used, but now the business are getting more aware about it, and what they are more focusing is on the asset liability management kind of thing. So let me just give you a brief about it. What is an asset liability management? So if we talk about the asset or liability management, it is basically a process of managing the use of asset and cash flows to reduce the firm risk of loss for not paying a liability on time. So this is something like, since we talked earlier a lot about the cash profits and all, we also understood the fact that in case of inadequate cash profit, there can be a circumstances where there might be profit appearing in my profit and loss account, but in actual I am short of cash. So in those kind of circumstances, what happens is generally that, let's say today I have incurred a liability of 50 lakh rupees. Now I have to pay this after 2 months. In the 2 months, I created, purchased those materials for 50 lakh rupees has been sold for 150 lakh rupees. I had made in profit and loss account, I have made a profit of 100 lakh rupees. I'll take out a very simple example. Now, after 2 months, that person came to me and asked for his 50 lakh. He said this thing that I have said sold you goods for 50 lakh rupees. Now you make me payment to me today because 2 months have lapsed. Your credit period is already lapsed. But I asked him one thing, that what has actually happened is, to the person I have sold the goods, I have given him the credit period of, let's say, 5 months. So for him, 3 months are still lying over there. So probably this person can come after 3 months. Now my purchaser gets, my basically vendor gets very angry on me. He said, you asked me to goods sold to be goods to me at 50 lakh rupees only on the terms and condition that you will be paying me back within 2 months for that money. So these kind of situation, just to avoid these kind of situation where a cash flow from an asset, in this particular case, the asset is a debtors, is expected, right? But it is not at this point of moment. It may be coming maybe in the future. So, but my liability is standing right now. It has to be paid right now. So these kinds of situation is basically called as an asset liability mismatch. Just to manage these kind of situations is called the asset liability management process. So it is a process in which we target to manage our assets cash flows against the liabilities of the firm. So there are two golden rules to it. One is never finance a long-term asset with the short-term finance. So what is a long-term asset? Anybody have any idea about it? What is a long-term asset for an organization? So in the other words, we can also say this thing, these are fixed assets kind of thing, wherein the cap, which are required for the basic operations of the firm, company or a firm, wherein it can be said as thing, the benefit out of this asset, the firm will be deriving over the period of more than a year. So these are long-term assets for the organization. So these kinds of assets should never be financed with the help of a short-term finance. So for example, let's say today I am going to purchase a new building for my business. I will never try to do this thing that whatever money I am collecting from my debtors, which is for the working capital of the firm, I can purchase the building out of it. Because ultimately what will happen if today I purchase the building out of my working capital, in a longer run, my business is going to suffer because I will not have ample amount of money available with me to pay to my creditors. And after a while, the creditors will stop their services and stop giving me goods and everything. This in long term is going to impact my sales amount because I will not have much of the stock available with me for sale. So one very basic rule is never finance a long-term asset with the short-term finances. There are two basic reasons for that. One is because the cash flows from the long-term assets will be deferred over a period of time, will be deferred over the future. However, short-term finances has to be repaid within a reasonable period of time. Another reason is that generally the cost of short-term finance is very high. So whenever we are making up this mistake, this high cost has to be borne for a longer period of time. So in any case, for financing a long-term asset, there are generally facilities available with the organization with the kind of term loans and all, which generally we have a lower amount of interest available with them. So it is a basic rule that you should always finance your long-term asset with the help of a long-term financing option only. Second is never finance a short-term asset with the long-term finance. So for example, if today I am infusing the share capital money into my business, which is a long-term finance kind of thing. If today I'm taking up a loan from the bank, a long-term loan, a term loan. So that money should never be used for daily expenses, because once it is being used for the daily expenses, those money will not be used for the business for further. So in any case, my long-term finances money, let's say share capital money kind of thing, that should always be used for the future growth of my business, for the new machineries, for the new setups, those kind of things. Because one, their cost is reasonably low, but if I start using my long-term finance for short-term needs, what will eventually happen is once at the time when I in need of the any of the long-term asset, those money is already being used or occupied in the short-term this thing short-term asset. So I do not have that much of ample money to be utilized for future growth. So automatically that will again hamper my future growth. So these kinds of concept, asset liability management kind of concept was very much available and very much aware in the banking industry, because generally in the banking industry we generally see that on the one side they have an assets in the form of loan given to the various customers, various businesses. On the other side, liability side, they have a deposits from the individual, something like us, like current deposits, saving deposits and all. So they always have to do a matching concept so that their loan or amount came within time once they have to pay to the other person. So now, but due to availability, due to the circumstances available, after the COVID impacts, after the all these things, once we have all the businesses have which have seen a lot of tightening up their finances in the COVID duration, we have seen this thing that lot of businesses, even though they were very much profitable, but then also what has happened, their money got stuck, and many businesses got stuck during that period. So these kind of situations, which comes once in a century kind of thing, they generally give you a shaken up and make you think to a different level, make you think to differently. So that is where this asset liability management kind of thing is also coming into the picture for many of the regular businesses. So with this, if anybody has a question, we can take up that, but otherwise we can conclude up the session. So what we have learned is importance of accounting and finance today. We learned the importance of top line and the bottom line in the business. We learned how and when to compare the profit to cash profits, how to control cash profits. We learned about profit versus the cash profit. We learned about the profit and the money are two different things. We learned about asset and liability management. So this was the complete session, today's session, in one particular slide, wherein I would like to conclude, and we can do the brainstorming now, or we can have the different questions from all the participants and the students.
Sir, actually, students are not writing in a chat box. They are sending the questions to us. We are getting a first question from the student start. You are specifically told us about the profit and cash profit. Sir, they are asking, for example, we are talking about the debtors. Debtors specifically is a kind of revenue which is expected to generate. So if in a balance sheet,
Right.
the debtors are increasing, will it be assumed that the profits will also be increased, and it will work for taking a kind of a mortgage or a kind of loan which we specifically conveying for the company, because the balance sheet will be checked. So is it okay that the debtors are increasing, then it means the cash profit is also increasing?
So let us understand in such a way, like I'll give you a practical example. So generally what happens in the financing industry, the banks do not finance the debtors altogether up to any amount. The banks generally have a limit for maybe 90 days or 120 days, depending upon industry to industry. Right. So let's say if today I have a debtor of 5 lakh rupees in my balance sheet, right? Which obviously means that my profits are going up in any case. because I have a balance sheet debtors of 5 lakh rupees. My debtors are increasing, right? If I go to the bank for getting those finances out of those debtors, maybe giving those debtors as in security, the bank will first do the aging analysis of those debtors, and he will say, like, whatever debtors which are available up to 90 days, I can refinance those, and also up to maybe keeping a margin of 20% rupees. So let's say out of 5 lakh rupees, I have an debtors of 3 lakh rupees which are up to 90 days. So first he will take a cutoff of 3 lakh rupees. Then out of those 3 lakh rupees, he will abstract a margin of 20 to 25%, and he will finance the rest of the debtors. So it can, in this particular scenario, in this particular example, out of 3 lakh rupees, let's say if an example, if the cutoff is or the margin is 20%, then automatically the financing will be only for 2,40,000. So having a debtor can increase your cash profits as well, but yes, up to they will have a certain limitations. And if I do not keep a proper control over my debtors, what will have in the longer run that most of my debtors will become non-financeable from the bank's point of view. And after a time, it will not be converted into a cash profit.
Yes, because debtors also include the bad debts. We don't have a surety that we will get it back. So do you think, sir, that
Is
whenever
that
we
audible?
are going to different kinds
Yeah.
of scams or a fraud, which are going to be happen in all these kinds of the sections which cannot be traceable, which cannot be acknowledged. For example, bad
Right.
debts, provisions, or you can say
So what happens generally in many of the businesses, what happened generally, let's say I'll give you another example of a very recent example of a COVID period only. So there was an organization which was having a tendency of overstating its debtors just to increase their finances, right? So they were generally overstating their debtors, and they were giving a wrong information to the bank and somehow managing it. During the COVID period, what happened is all of the businesses got stopped. Once the businesses got stopped, maybe for a couple, 1 quarter itself, but their realizability of debtors, since these debtors were already overstated, was not there, and they got into a mess in a sense. So whenever they used to go to the bank for having the more finances availed to them, bank used to say, first you recover your old debtors. You're already having a lot of debtors available with you. Why don't you go and recover those debtors first? So in these kind of circumstances, what generally happens is, if you are overstating your debtors, or maybe doing a small fraud or small cheat kind of thing with any of the financial institution, you are doing nothing but you are digging up your own graveyard actually, in a longer run.
It means specifically for a longer period of the time we can give this statement. But whenever we are going to look, either we are talking about a Satyam case, we are talking about this Punjab National Bank case. Either we are conveying the statement, the sarcastic statement has been given by the bank employees. Specifically, it is a duty of the concurrent auditor. So, in a case of Punjab National Bank, whenever you are talking about this asset liability management, it is mandatory for the banking. So don't you think, sir, there may be a
Right.
kind of effectiveness was missing in that, so that this fraud had been happened in that banking industry? They
Right.
have not specifically considered this asset liability
So
management.
actually what happens,
Hmm.
so actually what happens, I'm glad you are, you like took up these examples. So if you see in the general circumstances in India, so whenever a person is rising, the banks will keep on giving them the loans, and they generally never took into the consideration how much, what is their debt equity ratio and those kind of things. So what happens, even if we today we see a lot of talk has been done on the Adani's loan waivers and all these things, right? A lot of loans has been given to him to acquire the new businesses and all these things. So we have to somewhere, the banks also have to understand this thing, that by giving the a lot of amount of loan in consolidation, they are also increasing their risk of getting those into the bad debts. So same things applies to them as well. If a long list of debtors available or recoverable available in their balance sheet is actually putting them, the bankers, at the risk.
It means up till now, whenever we are talking about, there is no specifically suitable technique for it, that the banks are getting the idea about the efficiencies of the
There is,
company. Yeah.
there is a suitable, actually generally what happens. So whenever a large amount of loans are given, there is a highly skilled team generally comes over to the organization. They do all the analysis and everything. But on the other side, we also have to take care into this consideration that once the loans are granted, right, they are being granted with the mindset that the business is going to grow in the future, and all these things will be taken care in the future. However, things get worse once the business do not grow at that rate at which it is expected. So let's say if I can like give you this example, before COVID and after COVID, if the net worth of Mr. Adani has gone into the multiple raising up, today everybody is praising him, right? But once, if in case, God forbid, but any kind of bubbles comes out and any of his companies goes bad, automatically everything will come back to the bankers.
It means whatever has been happened in a Punjab National Bank, they are not so, or they have not actually checked. Then whose responsibility is that? Is it a
Both the
part of?
parties, actually both the parties. So in the case, if I talk about specifically for Punjab National Bank, if you see the case details more in detail, you can see this thing. There are a couple of things. Satyam was totally different and Punjab National was totally different. Punjab National Bank, it is more like in forged documents were produced. In the case of Satyam, the independent directors on the board, there was a governance issue because the investments were made to this an entity, which is actually the funds are being routed to a new entity, right? The meta case or metaverse, something like this, the name was there. The funds were routed to that organization, right? So it is totally the two different scenarios. Is I'm audible?
Yes, sir. Yes, sir. Yes, sir. We are
So
getting.
there is a couple of questions.
Yeah, we are getting on a chat box also. I may read it by and by for you. They are asking the most
Right.
important first question, how banks do asset management liability. Actually, they are asking how will they
Right.
assess this? What is that asset liability management?
Right. So in the banks, generally they have a very specialized team. So what happens generally, bank on the, if I talk about the liability side, generally they have a two kind of thing. One is in fixed deposit, which are getting matured. Then they also have to maintain the SLR and CRR kind of ratios, which are being mandated by RBI, right? That cash reserve ratios and statutory liquidity ratios. So those are amounts are already being, so RBI has already given them the mandate that you have to maintain. You cannot lend all the amount on the asset side. You cannot say, let's say today, if you have a deposit of 100 rupees, you cannot lend a complete 100 rupees to earn the best profits out of it. So that is how the RBI is being managing that. So CRR, basically the cash reserve ratio, is one way of that. Another thing is that banks generally have their internal specialized team who has an average maturity period for each and every advance. And they maintain this thing, their treasury team take care of this thing, that whenever this maturity is going to come, we have a sufficient balance available with them, so that there is never a situation once the depositor has come to take back his money and we do not have that money available with them.
Any other question related to this?
So is I'm audible? Sarthak has an yeah. If you have any other question relating to banks asset liability management, I'm happy to answer that.
So student want to ask about that can you elaborate the techniques of asset liability management? They want to know that what are the techniques of asset liability management.
I'm not, the techniques of,
So you are
so
not
for the
audible.
asset liability management kind of thing, generally what we do.
Rahul sir, are you there? I think there is some problem with.
Hello, is I'm audible?
Yes, sir, you are audible.
Yes, actually I got connection, missed connection in between. Can you please repeat where we were?
A student was asking about that what are the techniques of A&M in the practical scenario.
Right. So in practically what happens is generally, if we are talking about the banks or in the normal industry, because bank will have a totally different kind of thing, and in the other industry we have a totally different scenarios. So in the banks, generally what happens, they have an average maturity period of each and every deposit. So they do it based upon that, also with the help of a CRR. In the other industry, if I talk about, the asset liability management is being generally done by the treasury team itself. So what's happened is, any of the treasury team will ask for the budgets for collections from the collection team. And on the contrary, they have a liability schedules available with them. So they do it by matching up that. So any surplus money is generally being invested into the liquid funds or liquid assets available. Any shortage is generally done, being bridged with the help of a liquid financing, maybe with the help of an overdraft facilities, maybe with the help of an discharge of an earlier made investments.
Fine, sir. Sir, another student wants to ask about the risks which are associated with asset liability management.
I'm sorry,
They are
I'm
more
not able to
interested in
hear
asset
the question.
liability management. This topic has strike our students a lot. So there are many questions related to asset
Oh.
liability management, and I can see one question related to cash flow statement also.
So, okay. So the biggest risk available with the asset liability management is basically mismatch of that. Because what generally happens, these all asset liability management statements are being made based upon the projections, which a treasury team is getting from different departments. Let's say, for example, a collection team will give them the target that in this particular next month, they will be collecting, let's say 10 CR, right? Plus minus maybe a kind of 20% kind of scenario over there. So generally what happens, if the variation is more than that 20% bracket, then obviously there will be a higher risk of that asset liability management. And at a very big level, at a larger level, the business cannot afford to not to pay their liability on time, because that will do couple of things. One, there is a financial liability, financial penalties available on them. Second, that will also hamper their goodwill in a longer run if they do not pay on time.
So one question I just want to ask that what about the asset liability management? If we talk in context to startup, that how the things we can manage when we are just starting up, and what specific risk will be associated at that time?
Can I'm sorry, can you just repeat this question again?
It's a very basic question. I have just actually this just strike in my mind that if a person is starting his business, so what kind of challenge he will face while doing asset liability management? Because if we think that as you are telling us asset liability management, we need to have a synchronization
Right.
between asset and liability, and we are just managing out asset and
Right.
liability, so asset can benefit us most against
So,
the liability. So how can we do
right.
this? What will be the approach when the person is just starting up the
So
business?
we have to, yes. So I'll tell you very briefly, like we have to need to be very much cautious about while giving us the particular period, the credit as well as the collection period. So if I'm today, I'm purchasing a particular kind of good, right, from the market, I have to very much cautious about the terms and condition, like in what period I have to pay money back to them. One, on the other side, my debtors collection mechanism has to be very strong. The debtors collection mechanism is generally being done by two, three, is get affected by two, three factors. Once, as in it can be with the help of this thing that once my services are being provided or the goods have been delivered, so I have a short confirmation from the customer that he has received the goods and those are absolutely fine, so that my collection period gets starts right from there. Second, it will be there should be regular follow-ups with the customers about the dues. So generally what happens is in the businesses, we have a credit period given to the customers. Let's say if today we have given the 60 days credit period, that does not mean the payments get due within after those 60 days itself. We can start the about collecting our money maybe a 15 days later itself. That is the maximum period generally available in the terms. So government has also taken a step ahead with the help of an MSME Act, wherein they have given a collection period of 40, they have restricted the collection period of 45 days, right? So any MSME, basically that is micro, small and medium enterprise, the government has also taken up, government also understand that there can be a big risk to the smaller enterprise, to the new enterprise while starting up the business for these liquidity kind of things. So they have also included a legal statutory provision into the act that the payment to MSME, those are micro, medium, and small enterprises, has to be done within 45 days.
Fine, sir.
Sir, the two things specifically, you have mentioned whenever there will be a long-term sources of fund, it will not be financed for short-term asset and short-term funds.
I'm not getting the voice properly, ma'am. Actually,
Whenever we are talking about various funds, for example, there will be a seasonal requirement, there will be provisions which will be created for the short-term, just like a taxes, just like a debts, doubtful debts. Whenever these will be financed with the short term, because every time it will fluctuate, don't you think it will be risky or kind of cost will be higher if there will be a kind of planning or a forecasting which is going to happen for these expenses every time while making the budget? It will be better to provide aid or source it with a long-term finance, because it will be a kind of wastage of the working capital which is to be hoarded, which is to be blocked for this purpose. So is it a thing or vice versa?
you rightly mentioned, ma'am, like whenever we are blocking up or maybe we are keeping up at certain margin, there will be blocking of working capital, but the cost for that has to be built in into my model, because in any case, just by doing a non-compliance kind of thing, just by ignoring the fact that I ignore the fact that I do not keep any safety margins available with me, can have a worse results than just keeping an extra working capital. So I have to evaluate that situation, right? I have to somewhere, I have to strike a balance between that, whether maintaining maybe a 10% extra working capital will cost me more, or having a 20% shortage of working capital can cost me more. Somewhere we have to strike a balance between that, and we have to take a conscious call on that, because in any case, if I do not pay my suppliers on time, that can have a very big implication on my business in a longer run, because later on it might happen, if I default a couple of times, the supplier might go ahead and ask for the advance payment from the rest of the orders. So automatically that is going to impact my working capital even more. If their suppliers do not provide me any credit period stating the fact that the last time you did not pay it within time, so this time why don't you do this thing, you first pay me the money and then we will send you the goods.
But sir, if the specifically product is related to the season, if it is specifically depending on the kind of monthly requirement, they are very well aware that
Right.
the season of winter is coming. They are very well aware they need a kind of woolen, or in a case of rainy
Right.
season, they are very well aware either it is a kind of product which is related to rainy season, or a perishable thing, just like a food product. They are
Right.
aware that this is a requirement. Every year, this is a requirement. This is not changing, or you can say
Right.
either the demand will be fluctuating, but the requirement is there. Is it a kind of a good justice, or a kind of a good decision that they are going to comply it, they are going to fulfilling it with the help of short-term sources of the fund? Because
yeah, that's absolutely correct.
And most of the things are there whenever we are going through the various kinds of the scams and frauds which are going to happen. These are going to happen with the arrangement of the asset and liability, because every time the asset and liability proportionate will change with the change of the nature of the product, with the change of the nature of the company. So if as a stakeholder, we are outside stakeholder, how will we identify that, or you can say what will be the syndrome that something is going to happen fishy in this asset and liability management? If the frauds are going to happen, how will you detect it?
So very basic area, very basic thing where we can start off with the ratio analysis. So if we compare the particular company's ratio with that of the industry, that will give you somewhere a standard that whether the company is doing in line with the industry or not. That will automatically should give you a raise to your eyebrow whether the companies, if a particular company, let's say if I talk about an FMCG sector, which has an average of debtors turnover ratio kind of thing, you can say maybe of 60 to 80 days. If a particular company wherein on the other side has an 120 to 150 days, that should always give me a raise to my eyebrows, that what is happening, why the debtors are going up. On the other side, let's say if I see about a particular, as you talk about the food processing industry, if one particular food industry is maintaining a very huge inventory levels, again with the perishable natures available, if they are maintaining an inventory level maybe of 50% of their sales, annual sales, again can give me a hint, right? On the other side, maintaining even a very low inventory level, maybe only a 10 days inventory level, will leave them with the risk that they might have a situation of stock out and they might lose a business opportunity to earn out of it. So the ratio analysis is very important, that to be compared with the industry as well. So generally you can generally we have a couple of things, like we can compare it to the industry leaders per se, Their financials are generally available online if it is in public limited kind of thing. So that is very much important. Another thing is that if you see the trend analysis, if you pick up the couple of or maybe 2-3 years balance sheet, you will automatically tend to know this thing, like how the movements is being done into the various different class of assets and the liability of the company. So if we see a certain jump, right? So automatically that again should give me a kind of concern that why there has been a certain jump in particular class of asset or particular class of liability. Because everything, any change in the balance sheet, you should have a good reasonable genesis behind. You should be able to locate this thing why the management has taken up this decision to particularly to invest and not to invest in a particular asset.
It means for a purpose of it, there must be an analyzing capacity. It means there must be skills of analyzing the financial statement.
That's absolutely fine. So in any case, even the bankers, if you see, they generally ask for CMA data, which is nothing but the credit monitoring account data, right? So what happens if you can share with the, like, I can also share a sample copy with you. Probably you can share with your students as well. So generally that CMA data is nothing but a kind of business analysis for the or the balance sheet analysis for the organization. It generally ranges from 3 to 5 years.
The most important thing, whenever as a outsider, whenever I'm taking a decision in regard of investment in a company, as a stakeholder, I have to select the company, which company is performing better. On the basis of analysis, when it has
Right.
been performed, it will be performed on the publicized data of all the financial statement.
Right.
Now, as per conversions, updation which has been made in the ICI, there are 5 financial statements which is being publicized by each and every company. It is mandatory. It is a profit and loss statement, balance sheet,
Right.
cash
That's
flow statement, statement of changes in owners' equity, explanatory notes. What do you think? I am the outsider,
right.
but the outsider as an investor, as a either talking about creditor, debtor, whatever we are analyzing, either we are taking the example of pandemic scenario, 1920 or starting of 21. Lots of companies in a mid of 20s, they were performing well as per their financial performance. But whenever we are coming to the end of 20, it was showing something else. It means we are totally dependent on the publicized financial data. Do you think whatever we are analyzing only on this publicized statement? Do you think does it display the true picture, because there may be a case of window dressing or a creative accounting? So there are kind of syndromes.
So I'll break your question to 2 parts. So
Yes.
I'll break your question to 2 parts. One, as in for the listed companies, which are being listed, shares and all those things, and one as in the unlisted companies, right? If I'm moving further with the listing your company, with the investment to that, right? So generally, if you see, it is not only because they have the quarterly published available data, not the annual. So there are a couple of things. So one, we have to keep a very close track on the quarterly published data. Second, another thing, because in the quarter itself, a listing company can even go from a very high amount of sale price to a very low amount as well. That is also very much available. So another thing is, generally in any of the share broker applications available as of today, they have a separate column for news. So we have to keep a close eye on the news relating to that company. Because I'll just give you an example, even a small ticker, I'm just leaving aside market operators aside because nobody can control those. But in the normal circumstances, a small ticker of news can raise your company share maybe 5% to 10% up and down. So we have to generally keep a very close on that news column. So for the listed ones, because again, that is a very big topic in depth. totally different from what we are going into. This session is all about. So I'll not touch upon lot of on that. If I come to an unlisted one, a private companies, right? So other than the private listed data, which is available or the published data, which balance sheets filed with the ROC and all that, I would suggest always go there and ask for the copies of trial balances for last 2-3 periods. Because generally what happens is whatever being published or shown, those generally fulfills the requirement of the statutes. But from the investor's point of view, my requirement generally gets changed. The statutes are required, how much taxes are being paid, how much profit is being made, depending upon the whatever requirement of the statutes are. But I am more interested on will be a lot of non-financial data. Like say, if I talk about Zomato, right? Zomato published data might not be that attractive, but their non-published data, non-financial information might be of very much interest. Right, I'm just giving you an example. So in the startup world, if you talk about, if in the startups world we talk about, most of these startups are generally non-profit generating, but still they are getting a very huge valuations. The only reason is that because the investors somewhere sees the possibility, or they have the faith that one day they will be able to convert their non-financial data, something like number of users, downloaded, and all those things into the actual financial numbers. So that is where the investors today who are more focused on the startups and these non-private or non-listed companies kind of things generally take the initiative. They generally play upon this thing only, that how much the good idea it is, how much appealing it is. And then obviously another thing, what is then the scalability model for that? So scalability is very much important.
It means every time we have to differentiate between the listed company or a non-listed company.
Yes, that is very much necessary, because the principle which will apply to a non-listed or private limited company will not apply to a listed company. On the contrary, the principle, the market-driven rates from the listed companies will not apply to a private limited company.
Absolutely, sir. But whenever we are talking about it is for the sake of curiosity, I am asking. Whenever we are going through the analysis
Yes.
of the financial statement, banking, in the pandemic scenario, in a starting of pandemic, it was enhancing. Either we are going to the share market, the Sensex was increasing, the share prices was increasing. But whenever we are coming to the verge of it, either we are talking about after the month of July 2020, the scenario was totally different. So do you think it is a kind of rupture of their credibility, or kind of creating accounting which had happened in the starting of it, so that the people may not lose their faith on it?
So,
Or this was
ma'am, I would also like to mention one thing today.
Yes, sir.
Very interesting thing I would like to mention over here, that a week back I read a report from State Bank of India, which says that the Indian Sensex or the Indian share market is enhancing or is getting over, or maybe getting hype is creating based upon the TINA effect.
Yes.
Which is nothing but there is no alternative available as of now. So what is actually happening is we see a lot of like foreign investors coming over here, right? So at the start of the pandemic, when there was a kind of, still the things were not getting hampered. India was still, if you see that we got an COVID impact on the very later stage, rather as against the world.
Yes.
So the markets was booming because they were seeing the opportunity that the economy will not get impacted in that way. But once the India also gets starting impacting, there was a lockdown involved. Obviously, then and the period of uncertainty was there, because lot of places, lot of reports came in where it was mentioned that the numbers which are being reported are not correct by the central governments on all those things. So automatically these factors also impacts the market scenarios. So then we started seeing those falling up, and a lot of FDIs and FFIs, which were earlier investing, started withdrawing their money out of it. There is a one good factor I would say about Indian stock market is that we are not totally dependent on any of the one industry as such. The major one being the finance and banking and finance. But if we see the other countries, like if we see the China, 33% of their stock market is being based on the real estate.
Yes.
Right? If you see the Singapore, they have a huge role of finance and banking.
Absolutely,
So
sir.
this is one good scenario that we have a dispersed industry balance, wherein our largest industry, finance and accounting, has like finance and banking has only 20% or maybe less than 20% saying, which is a good condition to be in, I would say.
And sir, whenever we are talking about the economy of Sri Lanka, obviously there is a hyperinflation kind of situation which is going to happen in Sri Lanka. It is abnormal
Right.
circumstances. So if this kind of a circumstances in any country develop, then what do you think we as an entrepreneur, as an ordinary person, whenever we are thinking in which way the financial institute or banking will deal with this kind of the situation, because central bank have to take few steps, either they have to provide the
Right.
credits with a
Look,
liberal policy. Yeah.
Somewhere I think we should appreciate our central bank. They have taken up a measure on a very timely manner that we could be able to that the impact in India on the inflation front has been very much in control. If we see many of the other countries, our peer countries, they have been hit very hard.
Yes, sir.
Like if we see about something like in USA, UK, or maybe Singapore, there has been raise of 20 to 25% in the rentals. India still we have been able to manage something like 7 to 10%, not more than that, right?
Yes.
So somewhere we also have to appreciate our central bank. They have been proactive. Although at the time once they were increasing this thing, the interest rates and all, many of the persons also criticized them that they have increased too much. But yes, if you see in the longer run, this is actually giving a right impact. And we are with the last quarter's growth numbers like 13.5% of GDP growth has been, I would say, a tremendous in the year where everybody in the world is going on negative or maybe not negative at a very slow pace.
Absolutely right, sir. Agreed, sir. But do you think our banking industry, our financial institute industry needs to take lot of steps so that this kind of the scam?
Yes, there is a requirement for a lot of improvement.
Because you specifically mentioned in
there is a scope of lot of improvement. Yes, and also I would like to suggest you this thing that sooner or later we are already being seeing a lot of new regulations are being introduced by the government as well as from the Institute of Chartered Accountants of India as well. So the auditors are under preview. You will see nowadays you see a lot of things like the CS has been put under the scanners for all these things. So this is a outcome of those kind of things only, I would say. So as a custodian, CAs or auditors are also have this liability that somewhere they also have to do justice to whatever reputation they have been given by the market.
It means, do you agree that CA and auditors are also playing the inevitable part in all kinds of these situations?
Ma'am, every professions will have certain very good people, certain very bad people. Every profession will have to accept it, otherwise we cannot improve.
Agreed.
Just to come out of a problem, we have to first accept there's a problem.
Agreed. And the most important thing is that I think so, sir. I don't know you will be agree or not, but digital technology also plays a vital part. If we will be digital,
that's very much correct.
Yes, and
very much.
Yes, sir. The blockchain technology we are talking about artificial intelligence.
Yes.
Yes, this kind of the technology will be used frequently by our financial institute, by our industries.
Look,
And
I'll give you an example. I'll give you an example. I'll just give you a small example. Today, in the last for the last year, what is happening is like government has linked up all their bank account PAN numbers to a particular statement called as annual information statement kind of. Now, for filing a return, government already has a 90% of the information available for the salaried employee. The day is not very far away. You mark my words, maybe a couple of years after, you will get an SMS or a notice kind of thing wherein you will be suggested that as per us, as per the information available with us, let's say 10,000 rupees as a tax due from your account. Either you accept it or you send a contrary statement.
yes,
Because everything is now digitalized. Most of the sources, they have already tracked it now, right? So like there is in foreign country, they generally get an like their amount of taxes is already being deducted from the salaries and all. So we are moving ahead with the same kind of scenario, or maybe a step ahead, wherein all the information will be already available with the government, and you only have to accept it and pay the remaining taxes. You will not
Agreed.
leave with the many of the other options available.
Obviously, when there will be no option, they will be specifically directed towards the right path. Absolutely,
Right.
sir.
So again, I'll say you this thing with the if we talk about the legislative on the revenue legislative part, with the new faceless kind of things coming in, lot of corrections from the departments have already been curved out.
Yes. Agreed, sir. Agreed, sir. Any other question from the students?
Ma'am, students have asked about cash flow statement.
There are a
Sir,
couple of questions I could say which we have not dealt with. One was from the Sarthak Agarwal, that how working capital can be differ from the
yes,
large scale or a small
large
scale.
and smaller.
So if I talk about particularly from work, with respect to working capital requirement, right? There are a couple of things which we have to keep in mind. One, as in, what are my sources of finances for that working capital? Two, as in, the amount of working capital might differ from a large scale to a small scale industry. But yes, we also have to keep in mind the nature will not differ. The nature will remain the same. You have to manage in both the cases. If I talk about the source of financing, we have to be kept this thing in mind. A lot of new financial institutions or new schemes has been involved for the working capital part by the government. So many of the organizations, the problem with our country is that many of the persons are not available with the schemes available to them. So generally what happens is, if this information is not being passed to the right person, there will be always be a gap between the schemes shared by the government and the schemes actually availed by the many of the business houses. So the large business houses generally have the facility of different consultants with them, but for the smaller ones, they generally get deprived of these schemes because they do not have the right persons available with them to tell them what can be the most beneficial scheme for them. So that thing is always an hindrance for a small business.
Yes, sir. Uh, the session was very,
There is
very.
another question.
Sir, actually, one thing, the students are getting the answers and specifically they are writing to us. So I think we may
Okay.
share your mail ID and we will get the questions from the students, because whenever we are talking about these kinds of commerce and finance topics, our students are so delighted and they are so curious to ask various questions. They are actually the commerce students. They are having the background of commerce and finance. So
That's great, ma'am. And even afterwards, if you have any questions unanswered or something like this, you have my number. You can just drop me or you can write me on the email. I can help you with the answers and maybe clarifications. And also I'll share this presentation as well as the copy of that CMA data with you. You can share it with your students for their reference.
Yes, sir. Yes, sir. Thank you very much, sir. The session was very, very knowledgeable. We got a lot of learning from the session. Now I request Dr. Rupali, kindly give a vote of
Yeah.
thanks.
Yeah, thank you, Renuka ma'am. It was indeed very, very informative. I also learned a few things today. I'm more on the finance side and not on the accounting side. So it was very informative for me also. Specifically when you talked about asset liability management in banking
Right.
and help or working capital of a small or a large company, how it is different. So thank you very much for your time. We hope that we'll see you here in person someday.
Thank you
and
so
this
much
will
for the faculty as well.
Yeah.
Right, right. Thank you so much, ma'am, and thank you for this opportunity as well. Thank you so much.
Thank you so much, Rahul sir. It was indeed a very good lecture, and basically our student has raised the question related to ALM. It is a very useful topic, and we got immense knowledge sharing from your part. So thanks for that.
Right.
And I thank Rinka ma'am for organizing this workshop, and Rupali ma'am for moderating today's session, and logistic team for arranging all the things. Because of that only we are able to conduct such type of workshop. And last but not the least, our students who are actively participating in the workshop and actively trying to enhance their knowledge in the different aspects of accounting and entrepreneurship. So thanks to all team. And now I request logistic team to end the session.
Right. Thank you so much. Thank you. Good evening.
Thank you, sir.
Thank you, sir. Thank you.